Silver just crashed 5% overnight, down to $87.59, but that's not the real story. While the market tanked, something much bigger was unfolding behind the scenes. If you're stacking silver or trading it, you need to understand what's actually going on. And here's the kicker. The price you see on your screen isn't the real price. The real price is being hidden, and this massive disconnect could change everything. Stay with me. In the next few minutes, I'll show you why everything you thought you knew about silver is about to shatter. So let's break it down. Last night at 10:40 p.m. Eastern, someone dumped 2,000 futures contracts into the market during the quietest, thinnest liquidity window of the day. Most traders were sleeping and the market was a ghost town. This is a critical moment. Imagine a single seller dumping millions of ounces of silver onto a deserted street. What happens? The price collapses in a straight line. That's exactly what we saw. Silver went from $92 down to $87.59 in seconds, like a waterfall. But here's the part nobody is saying out loud. While this chaos was happening in New York and Shanghai, physical silver was trading at $159. That's a $13 premium. That's not just a small gap. It's the widest spread between East and West in modern silver history. So why is China paying $13 more for silver than New York? And why is New York dropping the price to $87? Something is off, and it's not what you think. Now, let's dive into the numbers. This wasn't a random market drop. It was a targeted hit. Remember, 2,000 contracts were dumped during those low-volume overnight hours. 2,000 contracts is 200,000 ounces of silver. That's 10 million ounces sold in one single move. And because liquidity was so thin, the price couldn't handle that kind of pressure. It cascaded. It triggered stop-loss orders, forced liquidations, and the price fell off a cliff. But here's where it gets interesting. The silver you see on the screen in New York isn't what people are actually paying for. The physical silver in Shanghai, the kind you can hold in your hand, has been trading at a $13 premium. That gap shouldn't be there. In a healthy market, arbitrage would close it immediately, but it's not closing. Why? Because there's no metal to ship. The vaults are either empty or they're refusing to release the metal. The price in New York is a mirage, and the reality is unfolding in the East. And that's the key. This isn't just about silver. It's about something much bigger. Now, let's talk about what this all means in the bigger picture. This isn't an isolated incident. This is part of a pattern we've seen before. Historically, when a market shows this kind of breakdown, when there's a disconnect between the paper price and the physical price, it signals a deeper issue, a breakdown in the price discovery process. But here's where it gets chilling. The behavior we're seeing is becoming normalized. The big banks, the ones holding massive short positions, are getting desperate to keep the lid on silver, and they've been using the same playbook to suppress prices for years. But this time, it's different. The system is being pushed to the breaking point. The premium in Shanghai, that's the real price. The backwardation in the futures market, that's the signal that the physical market is running dry. This isn't just market volatility. This is a warning. The system is unraveling. And if this pressure keeps building, it's only a matter of time before it explodes. Now, let's take this up a notch. If you think this is just a temporary fluctuation, think again. The silver futures curve is in backwardation. Let me explain why that's huge. Normally, when you look at a futures market, the price for future delivery is higher than the spot price. That's called contango, and it makes sense. There are storage costs, insurance, and other expenses for holding onto the metal. But when the curve inverts, when the spot price is higher than the future price, that's backwardation. And in a commodity market, backwardation isn't just unusual, it's a signal of serious imbalance. When silver is trading at $87 on the screen, but $100 in Shanghai, it's not just a small glitch. The market is screaming that there is an urgent demand for physical metal right now. The buyers in the East aren't interested in promises. They want the metal in their hands today. And when that backwardation persists, it means the system doesn't trust the future delivery of silver. It's the ultimate red flag. Now let's rapidly stack a few key developments. First, the Shanghai premium is still holding strong. $13 isn't a fluke. It's a warning shot. Second, the backwardation in the silver futures market is showing no signs of letting up. In fact, if it widens any further, the pressure will reach critical mass. Third, the vaults are getting emptier. I'm talking about Western vaults, New York, London, the big players who hold physical silver. The inventory reports are showing massive outflows. And as more and more physical silver flows east, the squeeze on the West gets tighter. But here's the big question. What happens if this continues? What happens when the physical market runs out of metal to deliver? The banks and institutions that are short silver are trapped. They either deliver the metal at a massive loss, or they try to buy back their short positions at whatever price the market demands. And that could trigger a catastrophic squeeze. Now, let's talk about you, the person watching this video, because while the banks are playing their games, it's the everyday people who feel the consequences. If you're holding physical silver or trading futures, this isn't just a financial play. It's about real-world impact. Silver isn't just a commodity, it's a store of value. But when you see the paper price of silver crashing in New York while the physical market in Shanghai is surging, it means something is wrong with the system. You might be wondering, how does this affect me? Well, it's simple. The physical silver that people are demanding is getting harder to find. And when more people start realizing the paper market is a shell game, they're going to demand physical delivery, just like those buyers in Shanghai. And when that happens, when the demand for physical metal explodes, prices are going to skyrocket. If this situation feels familiar, you're not alone. This has happened before, and it always ends the same way. But it's not just about individual buyers getting squeezed. What's happening here is much deeper. This is a systemic failure, one that goes far beyond silver. The real reason this market is so out of balance is because of how power is concentrated. Yet the bullion banks, the major financial institutions, they hold the cards. They can manipulate prices in ways that distort the true value of silver. But what's different this time is that the system is being pushed to its limits. Backwardation, the premium in Shanghai, these aren't just quirks in the market. They're flashing red lights that tell you the physical market is drying up. The thing is, the longer these signals persist, the harder it's going to be for the big players to maintain control. The longer the shortage continues, the more buyers in the East will pay whatever it takes to secure physical metal. And that's the tipping point. The market's starting to realize the paper price doesn't reflect reality anymore. The real price, the price that matters, is whatever someone is willing to pay for physical silver. And right now, that price is skyrocketing. So where does this all lead? There are two possible paths forward, and both are intense. First, if the banks succeed in holding the price below $80, the squeeze could be delayed. But it won't go away. The fundamentals haven't changed. The physical market is still drying up, and the demand for metal is only increasing. If the price stays suppressed for too long, the pressure will build to a breaking point. On the other hand, if silver breaks through that $80 level, if we close above it on Friday, then the floodgates open. The banks would be forced to buy back their positions. The market would experience massive volatility, and the squeeze could send prices soaring. That's the tipping point. Whether the price stays below $80 or breaks through, it's all coming to a head. And once that happens, there's no going back. Here's the deep takeaway. The silver market is breaking down, the paper price is disconnected from the physical reality, and the banks are fighting to keep the price down, but they're running out of time. The shortage is real and the pressure is mounting. If the price hits $80 and breaks higher, expect chaos. If it stays below $80, expect a temporary delay, but the squeeze will continue to tighten. The bottom line, possession is power. If you're holding physical silver, you're in a stronger position than the paper traders. And if you're still relying on paper contracts, you're betting on a system that's quickly losing credibility. The next few days will reveal who's right and who's left holding the bag. So what happens next? We'll find out soon. If you want to stay on top of this evolving story, follow me. I'll be tracking every move, and we're just getting started.